This January, we saw massive deliveries in both gold and silver. 50 plus million ounces of silver delivered in January. 15,645 or so contracts in gold in the month of January. 15,000 contracts. That's almost 50 tons of gold. We start by quietly reclassifying gold tier one. We then proceed to slowly draining the world's exchanges, the rise of the others, as you and I started talking about. We see repatriation from the Bank of England and the New York Fed by 40 plus central banks. Bank of India just repatriated almost all of their gold, over 100 plus metric tons since 1991, and they continue to buy more year over year than they did the previous year.
Last month's analysis highlighted the unusual market activity that began in December and continued into January. However, this year has been an exception, with 19,001 contracts delivered 3 days before February deliveries even begin. For perspective, 19,000 contracts, valued at approximately $5.2 billion, are on par with a significant delivery month despite January historically seeing less than 1/4 of that volume. This signals a notable shift in physical demand, raising questions about the market's underlying strength. Silver also saw elevated activity, but not nearly to the same degree. January just posted its best minor delivery month in at least 2.5 years, but it was not as outside the average range as gold. Gold CEO AndySchectman delves into the secretive actions and statements of central banks and key figures shaping the future of precious metals. He highlights that central banks are not just accumulating gold, they are doubling down, increasing their purchases instead of slowing down. In 2024, the People's Bank of China expanded its gold reserves by 44.17 tons, solidifying its position as the world's sixth largest holder of gold. That year, China's gold production totaled 377.24 tons, while domestic consumption surged to 985.31 tons. According to the China Gold Association, gold imports rose to 156.86 tons. According to Schectman, the message is crystal clear. Western investors are being misled into chasing short-term speculative assets while global powers are securing tangible wealth. This ongoing accumulation by central banks signals a significant shift in financial strategy that most investors fail to recognize until it's too late. Let's delve into the video to gain further insights. Before we begin, consider subscribing to the channel and hitting the bell icon to stay updated with the latest content.
This January, we saw massive deliveries in both gold and silver. 50 plus million ounces of silver delivered in January. 15,645 or so contracts in gold in the month of January. 15,000 contracts. That's almost 50 tons of gold coming off. Those are deliveries off of COMEX. And we see states that are doing all of this. And I look at this and it blows my mind that it is so misdirected by the people that tell us what's important. It's unbelievable. Most people don't understand what's really happening. And we try to explain to them that the softness in the physical market, it's ridiculous. It's the most contrarian indicator I've ever seen. And you're right. Where are all the people? Well, they're into a handful of stocks, 7 of them, basically. And you saw what happened, how fragile the whole ecosystem is, right? These guys over there, they're playing in terms of years and decades. And us here in the States, as foolish as it is, where instant gratification really isn't fast enough, where a 30% gain in gold is laughable, where Richard Russell said you make 7 a year, 7%, you're a rock star, over quadrupled that. And it's a joke because it didn't go triple digit in a few weeks or months or... And this is all happening where everyone's in 7 stocks, into Bitcoin, and into money markets, 7+ trillion into money markets. You want to talk about a potential rug pull? I mean, you blow up one big bank like Bank of America, where guys like Gregory Mannarino screaming forever that this is a dangerous bank. Ted Butler, while he was still alive, bless his soul, spoke very indignantly about them, though they were the big short in both gold and silver, replacing JP Morgan. 1 billion ounces short in silver, 40 million ounces short in gold. Blow up a bank like that. Let people really understand what bail-in legislation is and watch how fast the whole system, bang, blows up that fast, where people run to yank their money out of the banks. You think you've seen a scary environment? Watch what happens with a real bank run that blows up the entire system, sends interest rates spiking and bringing everything down. And then you talk about Bitcoin and the one thing I haven't read Catherine's report. I know you sent it to me. I was so busy all day. I want to get to it, but the one thing that I'm concerned about, if it even warrants being concerned, it certainly feels that way to me. I suppose I need to research it more, but with the underpinning of all of the stable coins and treasuries, as the rest of the world has shed treasuries and continues to let them roll off the balance sheet in favor of commodities, real assets, um, we're all going into Bitcoin. And the central banks aren't just slowing down their acquisition of gold, they're doubling down. The last few months of reported statistics, the end of the year showed a doubling of the 12-month moving average each month. They're not stopping, they are increasing. We see Saudi Arabia, we see China be caught by the import-export numbers. Sorry, we've probably been buying more than we said, or we didn't report that. And if it's bought by the Liberation Army, People's Liberation Army, it's not reported, even though it was purchased by the PBOC. We underreported it. Same thing with what is going to Saudi Arabia. With all of this gold that's unaccounted for, do you really think they're reporting it all? Of course not. They're also the largest producers in the world, the second largest producers of silver in the world. They're doubling down their efforts. We are all misdirected into risk on assets, and these folks are buying all of the world's commodities. I talked at length. The Chinese bought the London Metals Exchange. They're not just buying precious metals. The London Metals Exchange are all the base metals. Look at all the countries on the Belt Road. Look at Indonesia. Just became a full member of BRICS. What is Indonesia but the largest producer of nickel in the world? Their president, Widodo, said we need to build an OPEC-style cartel for rare earths as well. Everything they are doing is aligning with countries that are either strategically located via sea or land and or have massive supplies of natural resources, many of which are underdeveloped nations and working on these deals. And we're all focused on risk on assets.
The Financial Times reported that newly appointed Treasury Secretary Scott Bessent is advocating for a phased increase in universal tariffs, starting at 2.5% and potentially rising to 20%. President Trump later stated that he favors even higher tariffs and is considering targeted taxes on key industries such as steel, copper, and semiconductors. This contradicts market expectations that tariffs would be implemented selectively, as seen with Colombia, rather than applied broadly. Since these tariff plans are actively being developed by the Treasury, rather than merely hinted at by Trump, the U.S. dollar has been experiencing heightened volatility, with the dollar index, DXY, seeing significant whipsaw price action. AndySchectman believes that concerns over a potential 10% import tariff on gold and a 20% tariff on silver may be distractions from a far more significant issue. However, he emphasizes that the real risk arises when investors demand physical delivery, as seen in January with an unusually high volume of gold deliveries. He added that if this trend continues, it could expose severe weaknesses in the market, potentially triggering a significant financial disruption. Now, let's redirect our attention to a video.
Theory is that everyone's worried about a 10% import tariff on gold, and more so than silver. The argument against silver is that we're in a supply deficit here in the States, so he won't do it because he has to import it. Don't know if that's true or not, but it would make sense. With gold, on the other hand, you have, I don't know, I haven't looked lately. There's a guy on Twitter that does a great job of showing the rehypothecation of gold, but it was always in the neighborhood of 1,500% or higher. I mean, that's just conservative. It's probably much higher than that. But that means that the contracts are sold over and over and over and over and over again. 15 people have the same contract thinking they have their own contract is what that would basically mean. And cash settlement is very, very close at that rate. Where his manufacturing business needs lots of aluminum, had contracts they couldn't deliver, they cash settled. It's force majeure. That's what we're setting up for here. And these players are saying, man, I got all these contracts. And when you have a contract, if I go short and you go long, well, most people just cash settle. Most people like Miles Franklin, 2 bottles of water here. This is 5,000 ounces of gold in my warehouse, 5,000 on Comex. I sell here. I own physically here. If the price in my warehouse drops by $100, I'm down $500,000 in gold, but I went up 500,000 on what I sold short. I'm not looking to take delivery. I have it covered. A lot of the people are just speculating the way they do in buying stocks. So remember, you as the long have the right to say, no, 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 no. I'll stand for delivery. Thank you. And that's what we saw in January. Massive deliveries, right? So what if everyone says, I see you guys are screwed. Delivery, please. Now, isn't that what the Hunt brothers did? Sure is. Hunt brothers saw the same exact things, and the exchange changed the rules on them. Said you can go long just 1 million contracts or so. You can go short as much as you want. Please, thank you. I mean, stupidity. But the point of it is that, yes, that is the rumor. But I would look much past that and say what you see are these claims, these promises of delivery in London. You got a whole big vault full of IOUs and a little bit of gold. And I've been saying forever, and maybe this is it. You know, the little boy who cried wolf, here I am. One of these days, wolf are coming, and maybe this is it. Maybe they all say, we got them cornered, y'all. Let's stand for delivery and watch what happens. And that's what they're doing. They're getting it home preemptively in case there are tariffs because they know they cannot come up with the gold. But lo and behold, having the same problem in London with these delivery delays. So, you can only manipulate a market over a very long period of time by pushing it in the direction that it is going. They are trying to hold back the global demand of powers that are as challenging as us, especially when you combine them all together. Their coordination, their motivation, their sophistication, and their wealth have all gone parabolically higher over the past 2 decades. And now I think they're enjoying watching us kind of squirm on this. And no, if they wanted to, they could turn up the heat just like that. But they've been playing the long game so they can get as much as they can. If they turned up the heat that fast, it would have been force majeure a long time ago. The rules would have been changed. So let's beat them at our own game, they're thinking. Do it as long as we can until we have to pull the switch. And then things get very frightening in my mind. And that's the beginning of a reset. One of these big banks, the Western banks, fails to deliver, creates a daisy chain of defaults and of forfeitures and bankruptcies and counterparty risk. And that's how it happens because they don't just own gold. Remember, these banks have a lot of fingers and a lot of pies all around the globe, and they're all incestuously tied together. So, yeah, I mean, I don't want to over dramatize it, but that is ultimately, I think, something you could see happen if the powers that be on the other side of the table really wanted to turn up the heat.
Gold surged by $100 last week, nearing its previous record high of $2,790 set at the end of October. Since October 2023, gold has been bullish, climbing by approximately $1,000 by October 2024. This increase has been driven by rising demand for physical gold, coupled with ongoing global political and economic uncertainties supporting strong demand for gold futures. Gold's recent bullish trend, driven by physical demand and international uncertainties, signals its continuing importance as a safe haven asset. With geopolitical instability, inflation concerns, and ongoing economic challenges, gold remains a crucial asset for investors seeking stability. What factors are most responsible for driving gold's recent bullish trend? Join the conversation. Share your thoughts in the comments, give us a thumbs up if you found value in this video, and subscribe to stay engaged with our community.